Global growth is holding up better than expected, according to the OECD. The OECD raised its forecast outlook for several major economies in its latest outlook this morning, saying the investment boom in AI is offsetting some of the shock from US tariff hikes. The US economy is now forecast to grow 2% this year, up from 1.8% in September, and the eurozone's forecast has been boosted to 1.3%. The OECD says the European labour market is resilient, and it expects further growth to come from Germany's public spending increase. Luca Pennarola is Senior Europe Economist at BNP Paribas. Luca, the OECD sounds fairly optimistic on the Eurozone's economy. Do you agree?
Yes, we actually share this optimism. The European economy in 25 has shown an impressive degree of resilience, thanks to healthy household balance sheets, thanks to energy prices coming down. And overall, tariff front loading has helped, let's say, prop up the GDP numbers a bit. But looking ahead at the next few quarters, when we should see the first impacts, the first effects of the German spending plan, we continue to share this optimism.
As you say, that increased German public spending isn't yet feeding through into the real economy. How long will that take, and where will we see the difference first?
That's a very important question, and we're starting to see the spending data from the German Finance Ministry increase. So a degree of fiscal impulse is building up. Some sentiment indicators have started to react positively, but before we see the actual effects on GDP numbers, it may maybe take a few more months. But the encouraging signs are there, and let's say the spending data from the German Finance Ministry has made us even more confident in our positive view.
Can that spending counteract concerns about Germany's manufacturers struggling, though, amid weaker demand, in some fields cheap competition from China in 2026?
Well, we think that the German spending plan is the best possible response to these problems. Germany is facing some structural headwinds that you have mentioned, and those are not going to go away anytime soon. Now, what's at stake here? Now, Germany has lost competitiveness, meaning that it cannot rely on exports as much as it did in the past. So the answer from policymakers have been, let's use this fiscal space that we have in Germany in order to prop up domestic demand. So the response to the shock has been, rather than doubling down on export growth, trying to spur domestic demand, we should also have positive spillovers in other European countries as well.
And where will that happen? Where will spending in Germany, or how will it have a knock-on effect for other countries?
Well, for example, there is one economy, Italy, which is another big manufacturing hub in Europe that has been suffering in the last few years, also because of Germany's weakness. If you look at industrial production in Italy, has been basically going down since 2022, more or less in line with Germany. If Germany recovers, there are a lot of, let's say, business-to-business relationships between Italian companies and German companies, and therefore Italian manufacturing should benefit as well.
Inflation in the eurozone, on the other hand, ticked up to 2.2% in figures that came out this morning, but we are expecting it to fall below target and stay there for a while, aren't we?
Yes, there is still, let's say, a long tail negative effect on inflation from energy prices, from the stronger euro. So these factors are not going away anytime soon. So for us, the story for 26 is inflation staying where it is, maybe undershooting a little bit, and then slowly recovering towards the end of 26 and into 27, when we should start to see the impact of higher economic growth on domestic price pressures.
What do you expect then from the ECB? No moves for all of next year?
Yes. We're not expecting the ECB to cut interest rates in December because the degree of downside risks has receded. They think policy is in a good place, and to be honest, we agree. And we think that will remain so for the rest of next year. They can tolerate inflation going a little bit below target because it's driven by factors, as I was explaining, that are inherently temporary. And therefore, we see them staying on hold in 2026. And if I have to give you an opinion on what's the direction of the next move, we think that the next move from the ECB will actually be a hike. Now, the conditions for these are likely to materialize more in 27 than in 26, but for us, that is the direction of travel.
That was Luca Pennarola of BNP Paribas. Don't forget, you can watch more videos on Reuters.com.